Greetings, comrades. Liquidity of an asset simply means how easily we can turn that asset into cash. So if we think about a market that has a high inventory turnover, e.g. groceries, then you'd say that inventory in that case is highly liquid because it won't take long to convert that into cash, care of sales. Now, in the context of the VCE course, liquidity is simply a measure of the firm's ability to pay short-term debts as they fall due. So why is it important for a business to monitor its liquidity? Well, cash is the lifeblood of a business. So therefore, a business needs to ensure that it has adequate liquidity so it's in a position to pay off short-term commitments such as balances on accounts payable subject to the credit terms. Because we need to maintain a strong credit rating, so we maintain the ability to buy inventory on credit. 4 times a year, the business is required to settle up with the ATO for any GST payable. Also, if there's any loan principal, periodically we're going to be paying that off in order to service that debt. And then there's also the other operational expenses that need to be paid in a periodic fashion. So in the VCE course, we have 3 liquidity indicators. I'll do a vid for each of these and put them in the financial indicators playlist. But this one, we're focusing on WCR. So as laid out on page 13 of the study design, our formula for working capital is simply the ratio between our current assets and our current liabilities expressed as a ratio to 1. Now, when asked to evaluate any of the liquidity ratios, my recommendation is to take the DDD approach. Start with the definition of the ratio, then contextualize it by putting it in dollar terms, and then draw on the data to unpack how the business is sitting in terms of its liquidity. So let's go through 3 simple examples. So in terms of this one here, we've got 200k worth of current assets, we've got 80k worth of current liabilities. We put that in a fraction, and again, as VCAR stipulates, we've got to express this to 1. So we just go 200k divided by 80 and we get a ratio of 2.5 to 1. So you can see on the screen here, we've got the evaluation. So we start with our first D, the definition. Working capital ratio, a measure of the ability to pay short-term debts as they fall due. Then we put it in dollar terms to contextualize. We've got $2.50 in current assets for every $1 of current liabilities. So there's some soft marks there for the first 2. Then we evaluate by drawing on the data. And the key thing that we always want to look at is what's our cash position. So if we look at this one here, we've got 100k in the bank, and we've only got $80,000 worth of current liabilities. So this business is well placed to pay off those short-term debts as they fall due without even relying on collecting funds from accounts receivable or converting that inventory into cash. So the fact that this business has a very healthy bank balance means that you could say that they're in a strong position in terms of its liquidity and the ability to pay off short-term debts as they fall due. Okay, our second example. So this time we've got 200k worth of current assets to 100k worth of current liabilities to give us a 2-to-1 ratio. But again, let's have a look at our cash position. Nothing in the current assets because we've got a bank overdraft of 50k. So even though the ratio is pretty healthy, this has ramifications in terms of when we evaluate. So again, in terms of our triple D approach, we start with our definition and then we put it in dollar terms to contextualize. And we're not just going to say that this business is liquid. Yes, the ratio would generally indicate that we're well placed to meet those short-term debts. But if we dig deeper, we're not, because we have a 50k overdraft. And the problem is that we've got $100,000 tied up in prepaid insurance. That's going to be very difficult to convert that back into cash unless we literally nullify our insurance policy, which would be a massive risk and possibly impractical. And we also have another 60k tied up in inventory. So therefore, if the cash cycle is really slow on this, there's 160k of assets that are going to take a while to convert into cash. And in the meantime, we've got a negative bank balance of 50k. We owe $40,000 to our accounts payable. So if those debts are due soon, we are in trouble. So therefore, as I've got down with point number 3, you're going to point out the good and the bad of this. You're going to start by saying we do have a healthy ratio of current assets to current liabilities, but you're certainly going to draw attention to the overdraft of 50k and the fact that a lot of our current assets, the prepayments and inventory, are basically going to be very difficult to convert to cash. And this is the strength of the quick asset ratio. I'll save that for a future vid. So don't be scared when you're asked to evaluate to point out a pro and a con. So the pro is there is a healthy relationship of current assets to current liabilities, but when we dig deeper, this business has liquidity issues, particularly when we have an overdraft and we've got pressing expenses, accounts payable, a GST clearing liability, etc. All right, final example. So on the surface, things are looking pretty dandy here. We've got $1 million worth of current assets to our 100k worth of current liabilities. So we've got a huge WCR of 10 to 1. Is this good? Is this efficient use of our cash resources? So again, the DDD approach, we start with the definition. Then we put it into dollar terms to contextualize. And then we draw on the data. And so therefore, what we're going to highlight here is the fact that we've got an idle 800k sitting in the bank. Well, really only 700, because if we clear the deck with all of those current liabilities, we'd have 700k left over. So therefore, if that 700k just sits in the bank all year, earning 1% interest, let's say, on a savings account balance, that is a very inefficient use of our cash. So therefore, what you want to do here is provide suggestions on how the business would be better served. So what makes liquidity ratios different from profitability ones is these can be too high. So here's an example of a working capital ratio that is too high in terms of being efficient and practical for the business. So let's say we've got a long-term loan with NAB and we're paying it at $50,000 per year, and maybe we owe $500,000. Well, if we can pay that off with our huge cash balance, we're going to save ourselves a heap of interest. That's going to be good for our profitability. That's going to be good for our liquidity. Or if we've got any NCAs that are coming close to their useful life or simply inefficient in terms of their revenue earning capacity, let's upgrade. Let's use those funds to acquire new non-current assets that are going to provide us with a greater revenue earning capacity. And if we get 2 crosses on those ones, then we can always pull out, say, 600k, and we can invest it. Invest it in something safe that's going to get a superior rate of interest, like a term deposit or a government bond.